Hello and assalamu alaikum everyone. I am Kashif Kamran and welcome to the Advanced Audit and Assurance ACCA pre-March 2025 mock debrief. Now, just to make a clarification before you start watching this mock debrief, the clarification is that the ACCA has used two prior mocks to make this March 2025 mock for the students. One is the September 24 mock, from where the question number 1 and 2 of this mock has been taken from, and one is the June 24 mock, from where the question number 3 of the March 25 mock has been taken for. So when you're looking at the March 25 mock, it basically consists of two previous mocks, the June 24 and the September 24. From the September 24, ACCA has taken the question 1 and 2 and copy pasted that into the March 25 mock. And for the question number 3 of the March 25 mock, they have taken the June 24 mock, question number 3. So it's basically an amalgamation of the two previous mocks. So when you will be watching my debrief, in the debrief, you will look at a screen where I will be conducting the September 24 mock, or I will be conducting a June 24 mock. So don't just get distracted with that, because it's basically been taken from the previous mock papers. So there was no sense of conducting a new mock debrief because it was just coming from the prior mock debriefs I have conducted. So that is just for the sake of clarification, because a lot of time when you watch the video, I might be saying June and September, and you will get confused because you're looking for this mock debrief as a March 25 mock debrief. So this is just an intro clarification so that when you watch the video, you're all set and clear that what you are watching and why. Thank you. Now continue watching the question 3 debrief from the June 24 mock. Hello and assalamu alaikum everyone, and welcome to the session 3 of the AAA June 24 mock debrief. I am your tutor, Kashif Kamran, and today in this session 3, I am looking at the question number 3 of the AAA June 24 mock exam. Let's first see what the question was before we see the question on the practice platform in terms of reading and planning time and the writing time, and then look at a good answer. Now, the question number 3 was based around two companies, and there were two exhibits given. In one exhibit, we had the Showbiz company, and in the second exhibit, we had the Resistance group. The requirement was that using the exhibit number 1, recommend the methods in respect of the Showbiz company, which should be included in the Caledonia and Company report to TCWG, and explain the reason for inclusion, and the marks are 13. Now, this is not the first time the students must have seen a question around communication to TCWG. I've always recommended my students to do read the article on ACCA website under syllabus area E, which is audit report to TCWG. And this is again not the first time a question like such has come in past papers. So you need to read the exhibit 1, and in the exhibit 1, there must be some methods relating to Showbiz company, which as an audit firm, Caledonia and Company, you should be reporting to TCWG. But why? You need to tell the reason for their inclusion as well. Explain the reason for their inclusion. So if you say that I want to report this to TCWG, you should have a basis. Either the basis comes first, and then you tell I should report it to TCWG, or you should say I should report it to TCWG and why. So you have 13 marks, and every matter you identify which should be reported to TCWG will be worth 1 mark. Even if you talk about accounting treatment, it will be 1 mark. If you talk about materiality, it will be 1 mark. If you talk about something being under and overstated, it will be 1 mark. So just like you write an audit risk answer or a ROM answer, where you get marks for materiality, treatment, risk, and impact, that's the same way you might be getting answers. You will be getting marks in this sort of question as well. And wherever you say I should be communicating this to TCWG and why, you're getting an extra 1 mark for that. So it's an issue and why it should be communicated. So for issue, you're getting 1. For why it should be communicated, you are getting 1. Then using the second exhibit, which was about the resistance group, critically appraise in respect of the resistance group, the audit supervisor suggestion to issue an unmodified opinion. So we'll see whether the suggestion of the supervisor is right or wrong. If it is right, we'll justify why. If it is wrong, we'll justify why, and we'll tell the correct and the proposed emphasis of a meta paragraph in the audit report. So that means in the exhibit 2, we have been given like a section of the report, and in that we had an unmodified opinion and an emphasis of a meta paragraph. There must be something wrong with it, which we need to identify and discuss. So if we say the unmodified opinion is wrong, we'll need to tell what should be the right opinion and justify that. If we say unmodified opinion is right, we'll need to justify why it is right. Same goes with emphasis. Is it right? Is it wrong? And the justification. There could be any problem with the way the emphasis of a meta paragraph have been structured, the language of the emphasis of a meta paragraph, which should also be identified in part of the critical appraisal. 7 marks you have, so just 7 appraisal. Every point you write will get you 1 mark, so that's not a lengthy answer, and that wraps up the B part. You are not required to redraft the extracts of the report. You just need to find the issues within the report and explain the issues and tell what should be the correcting part of the report. That is it. So let's see the question on the practice platform before I show you my suggested answer. Okay, you can now see the practice platform in front of your screen, which is the question number 3 of the June 24 mock exam for AAA. And it's around the 2 organizations you can see on the left-hand side, Showbiz and Resistance. Now, first of all, we have been informed that you are a manager in the you have been assigned to the audit of Snowbiz, an unlisted company. That's number 1, and the year end for that is 31st of March. You are also responsible for the audit of a resistance group, whose year end is 31st of December and is in the completion stage, so on and so forth. For each of the question 2 and question 3, you have a total of 48 minutes, of which 12 minutes is for reading and planning, and then you have 36 minutes of writing. Now, just like I mentioned in the question number 1, the importance of reading and planning time, what you do in 12 minutes, you need to read the requirements, you need to read the case exhibits 1 and 2, you need to copy paste things from the exhibits into your word processor, and after 12 minutes, you should have a good looking word processor where you can sit back, relax for 36 minutes and write up your answer. You need not to go back to the exhibits again and again. Now, we've already seen the requirements, so we'll just go over the exhibit number 1, the Showbiz company, and from that exhibit, we'll try to identify which matters needs to be communicated to TCWG and why. So we'll open the first exhibit, and this is about communication to TCWG. Number 1, it says, the audit engagement partner has asked you to evaluate 2 internal control matters which arose during audit, and those 2 matters are given below, and consider the communication of these to management and TCWG of Oval Company in accordance with ISA 265, communicating deficiencies to those charged with governance, and ISA 260, so on and so forth. So, you know, ISA 265 deals with deficiencies and ISA 260 deals with overall communication you have with TCWG. So you need to look at the matters below, and you need to tell why you will be reporting them and what's so significant in them. The materiality has been assessed at $50,000. We know that since last few exam settings, examining team do give you the materiality threshold even in the section B as well. So the materiality threshold is given to you, which is 50,000. So anything above this will be important. You start with the government grant first. Our production accountant has recorded income of $1.2 million from a government grant upon its receipt in the bank account on 1st of January 20x5. They stated that this accounting treatment was consistent with how they had accounted for sales revenue. So a $1.2 million government grant, they have recorded it as income, just like they record a sales income on the receipt which is totally wrong, right? You all know that what IAS 20 tells us about the government grant. First of all, you got the grant on the 1st of January, and you need to see for how long this grant is for. It is written over here that the grant is given to you for a project to run over 24 months. So you should have recognized the income over a systematic basis over the 24 months to match the expenditures related with this grant. But you recorded 1.2 million at one go, which is a breach of IAS 20. That's one reason you should be reporting it to TCWG, because wherever you find a breach of a relevant standard, it is very important matter to be communicated to TCWG. Secondly, there is a misstatement as well, because you have recognized the entire 1.2 million on the 1st of January, despite the fact the grant was for 24 months. So if you go on a pro rata basis, it is the 1st of January. The year end of the company is, I think the year end was 31st of March, right? Just let me check that. Yes, it's the 31st of March, the year end, right? So that means only 3 months of grant can be recognized as income. So you will divide 1.2 million with 24, multiply by 3, and you will find how much of the income should have been recognized by the year end, and the remaining should have been, the remaining income is what is known as an overstatement of income and the understatement of the deferred income. So please identify on a pro rata basis, dividing 1.2 million with 24 months, multiplying it by 3 months then to find the amount which is to be recognized as income. The remaining is overstatement of income and understatement of deferred income. And now that's the second reason you should be communicating things to management, because whenever you find a material misstatement which exceeds your materiality level of 50,000, you should be informing that to the TCWG for rectification, so that the financial statement gives a true and fair view. So one is the breach of the IAS. Second is a material misstatement because the income is overstated, the deferred income is understated, and that exceeds the materiality threshold. So you should be informing this to the management. More importantly, there are conditions associated with these grants, and there are 3 conditions. If you look here, there is a grant document, and the grant document tells us that there are 3 conditions associated with it. The first condition is that the grant may compromise a maximum 20% of the project total budget. So you need to see what is the project total budget. The grant will be maximum 20% of the total budget. Now let's see that. The total budget is given. The total budget is $5 million. So if you take 20% of the $5 million, that will come to just $1 million. So the maximum grant you were eligible to receive was 1 million. You got 1.2 million of the grant. So 0.2 million is something which is to be repaid. So you need to inform management that 0.2 million, and that 0.2 million is more than the $50,000 materiality threshold, and that should be repaid, and you should make a provision for repaying that, and you should be informing TCWG that this repayment is important. So only a grant of $1 million should be recognized. 0.2 million, which is in excess of the materiality threshold, should be repaid. That's number 1. We saw the grant condition 2, that the grant is for 24 months. We already identified that you need to divide 1.2 million with 24 months to see how much of the income should be recorded by 31st of March and how much is overstated. Number 3 condition is greater than 50% of the filming must be carried out at the waterside city region. So more than 50% of the filming must be carried out at a waterside city region. That's condition. Let's see, has that condition been met? It tells us the audit team were restricted by the management from viewing the production schedule that would have been informed the auditor of the filming location of the production. So you have been stopped by the management to view the production schedule, which would have given you the evidence about the production at the waterside city region. So there is a scope limitation. you are unable to obtain evidence, the management has put a scope limitation on you, and you know that is serious. You need to inform it to TCWG because you have access to all information and explanation, and this could have a serious implication for your audit report as well. So you need to tell this to TCWG. So if you look at the absolute grant, firstly, they have recorded it like a sales income, which is absolutely wrong. That's a breach of IES, number one. Secondly, if you go on a pro rata basis over the 24 months, only 3 months of the grant income should be recorded. The remaining 21 months is overstatement of the income and understatement of deferred income. That's the second reason you should be telling that to the TCWG, because it's overstated and it's a material overstatement. Thirdly, you need to repay the grant, which is what you got more. You got $1.2 million grant. Instead, you should have got 1 million, because it has to be 20% of the budget, which is 1 million. So 0.2 million, which is to be repaid, is more than $50,000. And again, this becomes material. And again, this is to be informed to the management so that they have in knowledge that it is to be repaid. Then the waterside city region, 50% of the filming, we had no evidence about that because management restricted us, and that's the scope limitation. So we have a couple of things to inform. One is an IES breach. One is overstatements and understatements. One is the more grant we got, which is to be repaid. And then we had a scope limitation. So these are 4. And with all these 4, you are telling them that this needs to be informed to TCWG. So reason of inclusion, issue, 1 mark, reason for inclusion, 1 mark. So 4 and 4 becomes 8. You will already talk about at the beginning that $1.2 million grant is material because it exceeds $50,000. You're getting 1 mark for materiality. You also talk about that 0.2 million, which is to be repaid, is above the materiality. Then you will talk about the understatement and the overstatement is above the materiality. So wherever you comment on the materialities, you're getting 1 mark. Issue, commenting on materiality. If you're talking about the accounting treatment, you're telling the right accounting treatment of the grant. You're also getting 1 mark for the right accounting treatment of grant. You're getting 1 mark every time you comment on materiality. And for every issue you raise, you're getting 1 mark. And every time you tell why this is to be included, you're getting 1 mark. So I think there is more than 10 to 11 marks easily what you can get out of the grant scenario, just the way I explained to you. Look at the 3 conditions and work around it. Okay, then there was a second issue, which was about expense claims. A further issue was found where a sample of expenses were examined during the audit in breach of the showbiz company documented procedure. So it's a breach of the documented procedures of the company. A substantial number of expenses under 250 had not been authorized by the independent manager. Now, the word substantial is important. Substantial means a lot, and this is a breach of the company policy. So anything which is in breach of a company policy, the word itself says substantial. So we need to report it to TCWG that this is a breach of the company policy. The expenses are being claimed, but they're not being authorized. So this could be a waste of company resources, as if someone is claiming his personal expenses, showing as if they are company expenses. And this could be a very significant fraud happening in the company, which should be investigated, reported to the management, so the management can take timely actions and disciplinary actions as well. Number 2, the audit team found 33 unauthorized expense claims made and processed by an individual finance manager by the name of Dominic for amounts between 240 to 249. So this is another issue. One is the substantial number of expenses under 250 not being authorized, and one is a specific 33 expenses which relates to the finance manager, Dominic, and not being authorized. Now, this is important. A finance manager means a managerial level fraud. And a managerial level fraud is important because if you're not taking action against this finance manager, he will get more empowered to do more frauds in the future. He has done 33 unauthorized expenses this time. He might do 70 unauthorized transactions in the next year. You need to take action against him. This needs to be informed to TCWG because he's part of your senior management. He is your finance manager, such an important position and involved in a fraudulent financial reporting. So you should be informing this to TCWG so a disciplinary action can be initiated against Dominic. So one is the breach of policy. substantial expenses. One is the role of Dominic being a finance manager under question mark, and a disciplinary action against him is important. Number third, and the last one, is the claims have not been allocated to specific projects which they relate to, but have been accounted for as journal company overheads. So definitely there is a misallocation among overheads. These expenses have not been allocated to the specific projects, rather they have been put into the journal company overheads. So it seems like a misallocation between specific project overhead and journal overheads. It could be possible that your journal overheads are overstated and your specific project overheads are understated. This is another important issue which is to be informed to TCWG so that the allocations can be done rightly and the misclassification could be rectified. So three important issues: substantial expenses being unauthorized against the policy of the company, specific 33 relating to Dominic being a finance manager, and then some misallocation between journal overheads and specific overheads. I hope you will be able to write in the answer for this. I tried writing my answer for this, which I will be sharing with you. I'm not just reading it over, but whatever I have just talked to you is right here. I started first telling grant is above the materiality threshold. I get 1 mark here. Then I talk about that 1.2 million is recorded in full, which is a breach of the standard, and this should be informed to the TCWG. Then I talk about that the grant should be prorated over 24 months. You can see it over here. Then I talked about that if I divide 1.2 million with 24 months, only 0.15 million should be recognized for 3 months. So 0.15 million should be recognized as income. The remaining is overstatement of income, and the remaining is 1.05 million, which is currently overstated, and the deferred income is understated. Wherever you do calculation, you show some numerical workings, you will be getting an extra 1 mark for that as well. The third I talk about was the 20% of the budgets. That's right over here. And 20% of the budget means that 0.2 million should be repaid, and the 0.2 million is above the materiality threshold. Number 4, I talk about the 50% of the filming must be carried out at the waterside city region, but we didn't got evidence for that. It was a scope limitation, restriction imposed on the work by the management, and that is one reason we should be communicating. Then for expenses, I talked about the documented procedures. Breach of documented procedure is 1 paragraph. Substantial expenses. My second paragraph is around Dominic, and I calculated approximately 33 expenses with an average amount of 240 to 249. So on average, it becomes something like $8,000 of the expenses which has been unauthorized. Though this $8,000 is individually immaterial under $50,000, but the role of the finance manager is very significant, and you cannot just let it go because you're empowering finance manager to do more in future. Then lastly, the misallocation of expenses between journal overheads and specific overheads. So I've written 3 paragraphs, 1 each for every problem. And same goes with grant. For every grant condition, I wrote 1 paragraph. The grant income recorded as in 1 go, 1 paragraph. So I've split paragraphs for each issue, just the way I was talking to you. So please go through reading this answer, and that will make sense to you. Okay, now the second part of the answer, which is the critical appraisal of the report. And I will be writing it in this session with all of you, because that's an area where so far, so forth, the mocks I have checked, I'm not very happy. Students have done just messed up of their audit report rules, and they just spoiled the situation. Just let's see what was in resistance group and what was so difficult with this critical appraisal. Let's go above. This is resistance group in front of your screen. Let's see what was the issue and what should had been the right impact on the report. And then we'll see the supervisor report, what the supervisor has done. Resistance group is an unlisted group. So firstly, it's an unlisted group. That's important in a reporting question to know whether the company is listed or unlisted. This is unlisted, with several subsidiaries which operates in manufacturing and retail industry. These subsidiaries are audited by another audit firm. Intercompany trading occur between subsidiaries. That's quite normal. Intercompany trading occur between subsidiaries, but we know these intercompany tradings are more like related party transactions. All group companies have an year end of 31st of January. So that year end is important, 31st of January. More importantly, these subsidiaries are audited by other firms. So the parent auditor and the subsidiary auditors are different. The subsidiaries are audited by another audit firm. And we know as a group auditor, you have a responsibility to review the working papers of the component auditors, primarily if those components are significant components for the group auditor. Okay, intercompany balances, you know the treatment, they should be eliminated on consolidation, but they're also a source of related party transaction. So that should also be kept in mind because they are between the companies and they could be important. Let's see what is the issue. Group materiality has been determined by the audit partner at 23 million. So the group materiality is 23 million because we are standing at the completion stage of the group audit, not the subsidiary audits. The audit of the group for the year ended 31st of Jan is nearing completion. That's good. And the only misstatement unresolved at the group level relates to the intercompany balances between the two group subsidiaries. So this is the only misstatement which is unresolved at this point in time. And this misstatement relates to the intercompany balances between the two group companies. The subsidiary Absolution Company shows a debit balance of 43 million from the Wolsten Home Company, while the Wolsten Home Company has a credit balance due from the Absolution Company of 56 million. So both have a receivable and payable between them, 43 and 56. Now, when you net them off, when you just intercompany balances are eliminated on consolidation, when you do so, the audit file conclude that the unreconciled difference of a $13 million between both companies is immaterial. Your materiality level is 23 million. Definitely, if you look at that, it's immaterial, unreconciled difference. But try to understand, you're a group auditor. First of all, you're not auditing the subsidiaries. So being a group auditor, you had a responsibility that you should have talked to the subsidiary auditors. You should have investigated the breakdown of 43 million and the breakdown of 56 million to identify what is the reconciling item. What is the nature of reconciling item? Why is the reconciling item arising? And how it should be adjusted in the group financial statement. $13 million. I just mentioned that intercompany balances is not just insignificant when you look at their quantitative side, they are significant when you look at their qualitative side because they are transactions between the group companies and they're known as related party transactions. Moreover, we know sometimes these intercompany transactions are used by the group for financial statement manipulations. These intercompany balances could be used for saving profits, saving taxes, for moving the profit from one subsidiary to the other subsidiary, just for the sake of the tax purposes. We know a lot of subsidiaries are used as tax havens. You do transactions between subsidiaries close to the year end just to ensure that your profit is transferred from one subsidiary to the other, and so on and so forth, just to ensure that your tax implications are least. All such should have been thought about the auditor of the group. He didn't. He just thought 23 million, 13 million, 13 million is immaterial. That's quite an illogical conclusion. First of all, he should have investigated the 13 million difference reasons. It's quite possible that while you were investigating the reason, this 13 million could have become bigger. Number two, 13 million is qualitatively material because it's like a transactions between subsidiaries known as related party transactions, and moreover, these transactions can be used for some sort of a management buys, some sort of a creative accounting between subsidiaries and the group, and you need to be alert as you need to be skeptical as an auditor. If you're getting this knowledge for the first time, that's good. So $13 million is important, not unimportant. Number two, Resistance Group disposed of a subsidiary on 30th of June 20x5. So they disposed of a subsidiary on 30th of June. We know the year end is 31st of Jan. So it's after the year end, post balance sheet date, they disposed of a subsidiary. The subsidiary did not meet the criteria to be held for sale on 31st of January. So you probably on the year end, you didn't had any mindset of disposing of a subsidiary, or you didn't initiated the transaction to dispose it off. And for that reason, you didn't classify it as asset held for sale at the year end. However, the sale has been disclosed as a post-balance sheet item in the notes to the group financial statement as a non-adjusting event, IS 10. They have put a disclosure of this in the notes. The audit partner has determined that these disclosures are complete and appropriate. Now, the audit partner is saying this is perfectly right. So no arguments with the audit partner. He's saying this is right, this is right. So they've given a disclosure, and it's quite logical. 31st of January is your year end. 30th of June is your year end. 31st of January is the year end, and 30th of June is the time the transaction is taking place. So that's like February, March, April, May, June, 5 months. So it's quite possible that the conditions were not existing at the balance sheet date, and you decided to dispose of this subsidiary within the 5 months after the balance sheet date. So that's why it's not held for sale. Rather, it's been put as an IS 10 non-adjusting event in the notes to the financial statement, and the partner agrees to this. Now, this is an important disclosure. Number one, this is a disclosure which should be emphasized in your EOMP paragraph, because this is a disclosure which should come to the knowledge of the shareholder that one of the subsidiary has been sold out. It has not been adjusted in the financial statement. It has only been disclosed. So the shareholder should have a knowledge of that. Being an important disclosure, you should have given an emphasis of a meta paragraph, because it is the partner is saying disclosure as complete and appropriate. So disclosure is complete, no misstatement. It's appropriate, no misstatement. It is material. So a disclosure correctly made and is material is meeting the definition of an EOMP. Let's see what the supervisor has done wrong in the audit report. The audit supervisor has proposed that an unmodified opinion should be given with the inclusion of the emphasis of a meta paragraph. So first of all, we know the unmodified opinion will not come in because the $13 million difference, unreconciled difference, was material by nature. We talked about how it could be used as a source of creative accounting. So $13 million is no way immaterial. So unmodified opinion is wrong. It should have been a qualified opinion with a basis for qualified opinion, because $13 million is material by nature. So one, wrong. It is not an unmodified opinion. It is a modified opinion. And which modified opinion? Qualified opinion with the basis of qualified opinion. So you need to tell which modified opinion. With a basis, with an emphasis of a meta paragraph. Emphasis is right, because emphasis will come for the disclosure related to the disposal of subsidiary. Let's go for a minute to my Word file. Let me develop my notes. Critical appraisal of the report, we had 7 marks. I'm not writing the full answer. This is just the tutor notes. Tutor notes to help you formulate a complete answer. So I'm just giving you my thought process. My number one thought process is there is a $13 million unreconciled difference, which is immaterial on the quantitative basis, because your materiality threshold is $23 million. But then you will argue that this $13 million, firstly, should had been investigated further by the group auditor, as the group auditor is not the auditor of the components. So he should have given a special attention to the components, asking them, why is the $13 million difference coming in? So firstly, should have been investigated further by the group auditor, as the group auditor is not the auditor of the components, to identify reasons for this difference. Moreover, this difference is material by nature because these are transactions between group companies and could be considered as related party transactions. And secondly, these transactions could had been used by management for any sort of creative accounting, like moving profits and avoiding taxes between subsidiaries. Complex accounting treatments, right, comes with the group structure, and with the group structure, creative accounting becomes more complex because it's so easier for management to hide transactions for the purpose of tax benefits. So you can just add a bit of 1 and 2 sentences and seems like quite a good answer. So 13 million, first of all, on the quantitative side, then on the qualitative side, and you concluded that this difference is material by nature. Now, you've already said it's material by nature. So definitely, because it's material by nature, this will, if not adjusted, will lead to a qualified opinion followed by a basis of qualified opinion in the group audit report. Therefore, the supervisor statement that an unmodified opinion should be given is wrong. Full stop. Now see how many points I got. I first told examiner that $13 million is immaterial on a quantitative basis, so I got 1 mark here. Then $13 million firstly should be investigated for the reasons, 2 marks. Moreover, the difference is material by nature. I got at least 3 marks here. If not adjusted, it will be followed by a qualified opinion and basis, 5 marks. And therefore, the supervisor's statement is wrong, 6 marks. So that's how you write in the critical appraisal. I think this is an ideal answer. You can just add a sentence and 2, and that is it, because a critical appraisal cannot be longer than this. Critical appraisals can be written in proper sentences, not like short sentences. Look at my sentences. They're complete. They're not blur. Every sentence is making sense. Then you get to the second issue, which is disposal of subsidiary. The first issue was the unreconciled difference, $13 million unreconciled difference. Unreconciled difference, right? That's the first one. Okay, the next is disposal of subsidiary. Let's see what's right and wrong with disposal of subsidiary. We know the partner mentioned disposal of subsidiary. It was an event. It was an event after the balance sheet date, and the conditions did not existed at the year end. Otherwise, they could have classified it as asset held for sale, and the partner agrees to that, right? So event after the balance sheet date and the condition did not existed at the year end. Therefore, management has given an adequate disclosure of the disposal in the notes to financial statement. Number 1 mark, the audit partner agrees to the note saying it's complete and appropriate. Therefore, there is no issue. So everything is fine. An important disclosure, partner agrees to it, management has done the right accounting treatment as per IAS 10. Therefore, the auditor should emphasize the disclosure in an EOMP para, drawing shareholder attention to the specific note number where the disclosure has been explained in full. So they can go to that note number. You know how you start with the emphasis without qualifying our opinion, because you're fine with the treatment. So you're telling we have no qualified opinion on disposal of subsidiary. So without qualifying our opinion, we draw attention to the note number 10, where the disposal of the subsidiary has been discussed in full, for example. So the shareholders will go to the note number 10 and they will know this is not a qualified opinion because you're happy with the treatment. So you say, without qualifying our opinion, comma, we draw attention. That's just the language which you're not writing in the exam paper, but that's just for the sake of your knowledge. So this is disposal of subsidiary giving me another 3 marks. So I'm going to 9. I need 7 marks to fetch this critical appraisal. Now, for unreconciled difference, the supervisor opinion is wrong, but for disposal of subsidiary, the supervisor said an emphasis of a matter paragraph. So supervisor view that an EOMP should be given is right. So at least he's right on one side, he's wrong on the other. But there are problems with the language of EOMP, which is further critical appraisal. So you already got almost 10 marks. Now you need to criticize the language. It might take you to 16, 17 marks. You need to write 7 points you want to write in. The structure and the wordings of EOMP para. Let's see what's wrong in that. Let's go back to the exhibit. Look at the structure of emphasis he's given here. Let's see what is the problem. During the audit of resistance group, we noted an unreconciled difference between the intercompany balances of 2 resistance group subsidiaries, as the difference between the 2 intercompany balances was not material, and we are not the auditor either of the subsidiaries. We have not performed any further work. See, this is what I wrote in my answer to $13 million, that as a group auditor, we should have investigated $13 million. We should have identified the underlying reasons of $13 million, and they're writing it in the paragraph of EOMP that we are not the auditors of the subsidiary. We least bothered. Do you write such languages in EOMP? Do you tell the shareholders that we are not the auditor of the group, we are not the auditor of the subsidiary? You are a group auditor. You are responsible to evaluate the work of the component auditor. You are responsible to check their work. You need to evaluate any risky areas. You need to be skeptical for unreconciled differences. So why you are telling something which you should not tell in the audit report? But what you have done is wrong. You should have gathered evidence of the $13 million, but you failed to gather evidence of the $13 million. You can even write that in your critical appraisal. So is this the way you write the EOMP? Do you mention about immaterial balances between the two subsidiaries? Do you mention that we have not done any work? Do you put statements like that? Without qualifying our opinion, comma, we draw attention to the note number 10, where a disposal of a subsidiary on the 30th of June 20X5 has been described by the management, something like that. In addition, the company has sold a large subsidiary post year-end, and we deem this to be important to your understanding. We deem is like subjective, which is important, which is material, not deem, material. And you didn't mention the note number. You didn't mention where it has been put into the note numbers. So you have sold a subsidiary, but you didn't mention where that disclosure is given. You deem it to be important? No, this was material. So you wrote a lot of things in these emphasis, which should not be the case. First of all, you talked about the unreconciled difference. You talk about immaterial balance. You talked about that we are not required to do further work as a group auditor. And we wish to draw your attention to this immaterial misstatement. You never draw attentions to immaterial misstatements in EOMP. You draw attention to a disclosure adequately made in the notes to the account. So a lot of issues, right? If I can just take this paragraph and make my answer on the Word file. Okay. Wording and the structure. And I'm copying pasting here. So my first issue with this paragraph is EOMP does not draw attention to immaterial misstatements, rather draw attention to the specific note number where disposal of subsidiary is given. Number one. Number two, in EOMP, the auditor does not mention that we are not responsible for, we have not performed any further work. We are not the auditors of either subsidiaries, and we not performed any work. That we are not responsible for any audit work on subsidiaries, as we are not the auditors. We are not the auditors. This is a statement which itself is wrong. In view of the group auditor responsibility. Group auditor responsibility, you are all familiar with that. And such statements are not put in audit report, There could be other issues. I've already gone above my marks. Another thing is, you talked about the differences, but you don't talk about differences in the EOMP. And lastly, you mentioned, in addition, the company has sold a large subsidiary post year end. Which subsidiary? You did not specify that. We deem this to be important. The company has sold, Control C. The company has sold a large subsidiary post year end. It was not identified. The subsidiary name was not identified, and the year end date was not mentioned, and the date it was disposed, So nothing was mentioned in there. And lastly, and we deem this to be of importance. We deem this to be of importance for your understanding. Deem seems to be an unsure word. The proper wording should be, it is important. It is important for the decisions of the users of the financial statement. So you need to be very sure, right? You cannot use words like deem. So a lot of issues. I hope you can catch some of them to make a 7 marks answer. There were issues with the way you structured the EOMP. For one issue, EOMP was right. The unreconciled difference, you need to give a qualified opinion. I justified that. So the supervisor viewpoint on an unmodified opinion was wrong. His viewpoint on giving emphasis was right, but he structured the emphasis in a very unprofessional manner. So almost like 4 bullets here. You can see almost like 4 bullets here, 8, and you can almost see like 5 bullets here, 13. You need to choose a 7 marks answer from here. So any 7 points would be worthy in exam paper. This is how you do the critical appraisal. So this is not a tutor notes, but this is rather more of a complete answer now, right? This is a complete answer. A complete answer. I thought I would be writing a shorter answer, but I've almost written a full. So you have answer for question 3B, and you have answer for question 3A right here. So I hope You can evaluate your mocks after my emails have come to you, and wherever I have said you've done something wrong, you can just check on with this debrief and with my mock answer. So I hope you thoroughly enjoyed this mock debrief around the question 1, 2, and 3. It will help you self-evaluate your weaknesses, which I have emailed you in my mock assessment. I wish you all a very best of luck. Take care, and I wish you the best with your upcoming June 24 exams. Kashif Kamran signing off from this mock debrief session.